Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Big bets on a Bitcoin ETF. The first futures-backed Bitcoin ETF has officially begun trading and others could soon be listed. But when will we see a real Bitcoin ETF? The United States and Bitcoin's hash rate. The land of the free is becoming ground zero for proof-of-work cryptocurrency mining. The pros and cons of this trend. Preparing for Polkadot's Parachain slot auctions. The overlooked announcement that could take DOT to new all-time highs and spark an altcoin rally. Everything you need to know. Tether in trouble. The CFTC hits USDT's issuer with a massive fine over the reserves backing its stablecoin tokens. When will the stablecoin crackdown finally come? Contrasting views on cryptocurrency. Fitch sounds the alarm over stablecoins, and IMF coins the term cryptoization as part of its anti-crypto crusade. Why other organizations aren't concerned. Interest rates and inflation to rise. Record high rises in prices for consumers and producers puts the heat on the Fed to taper. What this means for the crypto market. Evergrande's final stand. China's now infamous property developer is scheduled to crush global financial markets on Friday as other Chinese property developers start to warn of their own debt defaults. Should you be worried? And a closer look at a possible correction in this week's crypto market forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now, for today's top stories. Assuming the SEC didn't F things up, the first Bitcoin ETF should be trading on the New York Stock Exchange as you watch this video. Trading under the ticker BITO, ProShares Bitcoin Futures ETF is the first of a few futures-backed Bitcoin ETFs that are expected to list on US stock exchanges in the coming days. Next up seems to be the Bitcoin Futures ETF by Valkyrie, which will be listed on the Nasdaq under the ticker BTF. Given that ARK Invest's Bitcoin Futures ETF also recently received a ticker, it will likely be the next. Now, as I mentioned in my video about futures-backed Bitcoin ETFs, these investment vehicles have no direct effect on the price of BTC besides the hype associated with their initial listings. That's because all they do is mirror the price of the Bitcoin futures contracts on the Chicago Mercantile Exchange, or CME, which does not hold any physical Bitcoin. This is why you might have seen a few comments criticizing the current Bitcoin ETF as not being a real Bitcoin ETF. A real Bitcoin ETF is backed by BTC, not pieces of paper trading hands behind the scenes. Although some analysts believe that the approval of a futures-backed Bitcoin ETF means a physically backed Bitcoin ETF approval will be pushed to next year, the evidence suggests otherwise. In response to last week's rumors about the approval of a futures-backed Bitcoin ETF, a few asset managers filed for physically backed ones. One of these asset managers was Grayscale, which is looking to turn its Grayscale Bitcoin Trust into a physically backed Bitcoin ETF. Whether the SEC will grant Grayscale its wish remains to be seen, but the winds seem to be blowing in Grayscale's favor. As a consequence of China's crypto mining ban earlier this year, Bitcoin's blockchain has become more decentralized as Chinese miners set up shop overseas and unaffected miners expand their operations. Funnily enough, the United States is quickly becoming Bitcoin's new hash rate hub. It currently contains over 35% of Bitcoin's computing power, and this percentage will continue to rise for the foreseeable future. This is making many institutional investors more comfortable with investing in cryptocurrency because of the additional oversight regarding energy use. I'll quickly remind everyone that Elon Musk said that Tesla would accept BTC as payment once again once most of Bitcoin mining was done using renewable energy. This threshold is close to being crossed, and it's likely that Tesla and other publicly traded companies will lean more into cryptocurrency as it becomes more compliant with ESG. Now that's a big buzzword that I won't get into here, but it's something that could make or break the crypto market like it did back in May. Now, I'll be making a video about ESG later this week, so stay tuned for that. Now, as amazing as crypto miner migration into the United States may be for cryptocurrency, it also poses an existential threat to Bitcoin and other proof-of-work cryptocurrencies. This is simply because the United States is set to become the new China, meaning that it will eventually host most of Bitcoin's hash rate. The formation of institutions such as the Bitcoin Mining Council means most, if not all, the Bitcoin mining operations in the United States will be closely monitored on the grounds of being green. This information would make it easy for certain anti-crypto authorities to coerce the owners of the Bitcoin mining companies into changing the Bitcoin blockchain for their benefit or investor protection. Now, thankfully, the risk of this happening is quite small for the time being, though the same can't be said for proof-of-stake cryptocurrencies, which are more easily corrupted by special interests. More about that up there in the top right. Speaking of proof-of-stake cryptocurrencies, Polkadot has announced that its highly anticipated Parachain slot auctions are ready to begin. For those unfamiliar, Polkadot's Parachains host Polkadot's smart contracts. Because there's a limited number of Parachain slots, an auction mechanism is used to determine which project gets a spot. This basically works by having projects lock DOT on Polkadot's relay chain and take a snapshot of each project's stake at a random time before the auction ends. Now, DOT holders can delegate their coins to projects to help them win a Parachain slot in exchange for tokens. This is called a Parachain loan offering, or PLO, and unlike initial coin offerings, or ICOs, any DOT that's delegated is not given to the project or sold. It's simply locked for the duration of the Parachain lease period, after which it is returned. Polkadot's first round of Parachain slot auctions will begin on November the 11th, and 5 auctions will be held back-to-back, with each lasting 1 week. If Kusama's Parachain slot auctions are anything to go by, Polkadot's Parachain slot auctions could send DOT to new all-time highs around that time. Participants in Polkadot's PLOs could also see some handsome returns if they pick the right projects, and I happen to have a video about the top Polkadot projects, which you can find in the description. If you're interested in Polkadot, now is the time to do your own research. Pro tip, remember that your DOT will likely be locked for 2 years if you participate in Polkadot's PLOs, so make sure those token rewards are worth it. Most importantly, make sure to check that you're allowed to participate in Polkadot's PLOs before you invest, because the last thing you want is a regulator breathing down your neck. Regulatory scrutiny is something some crypto projects are very familiar with, and one of these is Tether, which was recently slapped with another massive fine. This time, it was the CFTC demanding $41 million over Tether's false statements that the USDT in circulation was fully backed by fiat currency. As I mentioned in my video about the assets that back stablecoins, almost every single stablecoin is backed by debt of some kind. Whereas Circle's USDC and Paxos's USDP are backed mostly by government debt, Tether's USDT is backed mostly by corporate debt, specifically risky corporate debt. This wouldn't be a problem were it not for the fact that Tether had specified on its website that every USDT was backed by a dollar sitting in a bank, a wording which was suddenly changed when regulators came calling a couple of years back. The funny, thing is that Coinbase had a similar claim on its website about USDC, which it also amended after Circle published a detailed breakdown of the assets backing USDC in July. Coinbase and Circle make up the Center Consortium which governs USDC, and this begs the question of when a similar fine could be levied against them on the same grounds. After all, stablecoin scrutiny seems to be at an all-time high, and we're supposed to see some action on that front any day now. The thing is that institutions are obsessed with stablecoins because it allows them to earn higher yields on their dollars. Dollar-backed stablecoins are also secretly liked by the Fed because they make it easier for the dollar to spread. This dual reality has created a conundrum for institutions, but most of the conflict around stablecoins is taking place at the international level between various organizations. Yesterday, Fitch Ratings warned that Tether's USDT could pose a threat to financial markets because so much of it is backed by corporate debt. Fitch acknowledges that this risk is minimal at the moment, but the meteoric rise of stablecoin market caps means it could become a serious issue down the line. This is in contrast to what the Global Financial Stability Board said last week, which was that stablecoin sector, quote, remains niche. Now, as I mentioned in my recent video about the Bank of America's cryptocurrency report, though, it's expected that the collective market cap of stablecoins will top $1 trillion in just a few years' time. The IMF must be looking at similar projections because it warned that, quote, cryptoization is a threat to the global economy. The IMF identifies El Salvador's recent decision to adopt BTC as legal tender as one of the many signs that cryptocurrency adoption is accelerating, and the IMF calls on central banks to accelerate the development of their central bank digital currencies before they lose control of their currencies. Now, as I mentioned in my recent video about the BIS CBDC report, CBDCs are years away from reaching regular people. In the meantime, fiat currencies are losing value by the minute, and last week we got another glimpse of just how bad the situation is. The US Consumer Price Index, or CPI, hit a 13-year high of 5.4%, and the US Producer Price Index, or PPI, hit an 11-year high of 8.6%. Note that these are the official inflation figures. Unofficial inflation figures are 15% by some estimates, and this inflation is, of course, much higher in certain industries, namely energy. As JP Morgan recently pointed out, Bitcoin has become the preferred inflation hedge amongst institutional investors, and this is likely a part of why BTC is pumping while gold continues to slug along. This is certainly good news for us crypto holders, but the gravy train could soon be cut short by the Federal Reserve. This is because Fed Chairman Jerome Powell said that the Fed will reduce its purchases of government bonds if inflation is running hot. Now, to quickly recap, government bonds influence interest rates. When lots of government bonds are being bought up, interest rates fall, and the Fed has been buying hundreds of billions of dollars in bonds every month for over a year now. Tapering, aka reducing these government bond purchases, would increase interest rates across the board and would wipe out anyone who's over-leveraged, aka borrowed too much money. Newsflash, that's basically everyone, including the government. Now, despite these risks, the Fed seems pretty dead set on raising interest rates in November, which is just a couple of weeks away. Here's the thing, though. Fed Chairman Jerome Powell will be up for re-nomination in early February. This is when politicians will decide whether he gets to sit behind the money printer for another 4 years or must return to the swamp from whence he came. Raising interest rates could crash the stock market, and that would be a very bad look for someone who's about to reapply for a job. Conversely, letting inflation run wild will have regular people calling for retribution, but clearly this isn't really a concern for any central bank or government. Institutions seem to be leaning towards the former scenario. They don't believe the Fed will actually raise interest rates for this reason. Even so, a Fed taper is possible and therefore a risk to the crypto market to keep in mind over the medium term. There's an even bigger risk to the crypto market to keep your eye on in the short term, though, and that is Evergrande. Now, as many of you will know, Evergrande is one of China's largest property developers, and it's on the verge of defaulting on its billions of dollars in debt. Evergrande technically defaulted late last month, but was granted a 30-day grace period, which ends this Friday. Over the last week, 4 other Chinese property developers have missed debt payments totaling over $1 billion. Now, though these smaller property developers can't do much damage, it reveals the extent of the effect that Evergrande is having on the Chinese housing market, which the government continues to insist is completely contained. However, the reality is that the financial system is interconnected. A failure to pay back debts in one place means someone else can't pay back debts in another place, and a crash in China's housing market almost certainly means a crash in the global housing market. In the context of cryptocurrency, Bloomberg believes that Tether's USDT could be partially collateralized by Chinese corporation debt, possibly even Evergrande debt. This means crypto could be hit extra hard by an Evergrande fallout, but it's possible this effect will be minimized now that Chinese crypto holders have mostly been cut out of the equation. In any case, the Evergrande rabbit hole goes much deeper than you think, and you can see where it leads by watching my video about it, and that is in the top right. Now, in terms of whether you should be concerned, the answer seems to be no. This is because institutional accumulation of cryptocurrency continues regardless of any financial FUD. The proof is in the price action, and that brings me to my weekly crypto market forecast. It's been a green week for most cryptocurrencies, but this trend is scheduled to come to an end. First, the Bitcoin futures ETF will probably be a buy the rumor, sell the news kind of event, the way El Salvador's Bitcoin adoption was in September. Second, the RSI and Bollinger Band indicators suggest we're a bit overextended, though there could be a bit more room to the upside in the short term. This is because BTC is printing a small bull flag on the daily, which could take it up to 67k. This brings me to the third reason why the crypto market could see a dip, and that's because we seem to be entering another institutional Wyckoff distribution pattern. If we go back to mid-February, you can see the price action looks eerily similar to what we're seeing now. Assuming the same pattern plays out, we could crash down to 50k before moving higher, so don't you dare go long with leverage. Not financial advice. Now, you can learn more about Wyckoff by watching my video about it, and it'll be down there in the description. Turning to altcoins, this week's winners are Stacks, Perpetual Protocol, Polygon, Polkadot, and Zcash. Quite the combination, if you ask me. Starting with Stacks, STX was a weekly winner last week too, and the cause of its current pump is the same as last time: NFTs on Bitcoin. STX seems to be struggling around the $2.50 mark, but could manage to break that barrier of resistance if this NFT stuff continues. As for Perpetual Protocol, I was under the impression that Perp was pumping because of all the Chinese crypto investors that continue to get pushed off centralized cryptocurrency exchanges. Lo and behold, the real cause is that Perpetual Protocol is releasing NFTs of its own. Perpetual Protocol also partnered with and invested in another DeFi protocol called Impossible Finance. Now, Perp's price action has been pretty poor, but its price has been steadily rising higher even over the last few months. We'll see how long this uptrend can be sustained. Polygon's Matic token seems to be headed for the opposite direction despite its recent pump, which was caused by some insanely bullish announcements. These include the possibility of a Yearn Finance deployment on Polygon, Matic listing on South Korea's largest cryptocurrency exchange, and a partnership with DraftKings for professional sports NFTs. Matic's steady decline seems to be due to intense sell pressure coming from early investors. Look no further than Matic's aggressive vesting schedule for evidence of this. When it comes to Polkadot, well, you'll hopefully recall that DOT is pumping because of Polkadot's upcoming Parachain slot auctions. Zooming out on DOT's price action tells one hell of a success story, and I commend everyone who held through that dip, including me. Well done, me. Now, DOT appears to be on the verge of another pump, but it looks like it could go both ways. On the upper bound, we're looking at a retest of DOT's all-time highs, and on the lower bound, we're looking at around $34, a historically strong zone of support. Lastly, we have Zcash, which is a cryptocurrency that I haven't heard about in quite some time. ZEC is pumping because of something I never thought I'd see, and that's a grayscale trust for a privacy-oriented cryptocurrency. Stellar's XLM and Horizon's Zen were also given their own respective trusts, and this suggests that the institutional appetite for privacy is at all-time highs. Unfortunately, the same can't be seen on ZEC's price history, which is pretty brutal no matter how you slice it. There is a lot of resistance on the path towards a new all-time high, but maybe Grayscale's new Zcash trust will give ZEC a thrust. Now, you can learn about a couple of the privacy coins on my radar by clicking the link in the top right. And if you're feeling adventurous, you can head on over to the Coin Bureau Clips channel to watch me mine Monero. You can find your way there using the link in the description. And that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you want more of me, head on over to Twitter, TikTok, and Instagram to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie or both. Links to all these resources are in the description. Thank you so much for watching, and I'll see you all in next week's episode.